You made a really stupid bet that went bad.
Let's move on. Our other big story tonight, a wild day on Wall Street, and it's all about Santa Clara. What's happening with Silicon Valley Bank, and why is it causing a ripple effect in the world of finance here? One of the most trusted local banks is in trouble.
It's all one big
Ponzi scheme.
Silicon Valley Bank, known in the tech world as SVB, lost 60% of its stock value just today.
The banking system has failed us yet again.
Our most urgent task upon taking office was to shore up the same banks that helped cause this crisis. It was not easy to do. And everybody in between is that we all hated the bank bailout.
On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets.
President of the United States.
My friends, I want to talk for a few minutes with the people of the United States about banking.
There's a problem going on in the world, and it's not just America that's dealing with this issue. The banking system has failed us yet again. The system itself was supposed to have safeguards in place to protect the public after the 2008 financial crisis. What we once coined as too big to fail may very well be back.
Things calm down, and then we get SVB Financial, a bank basically collapses. A lot of that has to do with these higher rates. And so when you look at that, it just all goes back to these rate hikes that are really just damaging everything.
Over the course of 5 days in March 2023, 3 small to mid-sized U.S. banks failed as regulators tried to prevent global contagion from spreading across the world.
Pretty much. I mean, that was the decision of federal regulators on Friday when it shuttered the bank. What happened with there is we saw a number of things, the effects of higher rates. One, you have deposits dwindling because as rates go up, things become more expensive. People spend down their savings. So they had to get that funding elsewhere, which meant that they had to sell down their securities portfolio at a loss.
With the recent collapse of Silicon Valley Bank, better known as SVB, it's like taking a stroll back through memory lane.
In the Oval Office today, the president blasted Wall Street bankers for taking billions of dollars in bonuses while pleading for a bailout to keep them afloat.
At a time when most of these institutions were teetering on collapse and they are asking for taxpayers to help sustain them, that is the height of irresponsibility. It is shameful.
The president told advisors the anger rose straight from his gut as he read reports that New York City securities industry employees got more than $18 billion in bonuses in 2008, the 6th highest total on record. It's about the same amount they got in 2004, but then Wall Street was flying high. Now they're getting fat bonuses while millions of Americans are watching their nest eggs evaporate. It's time, the president lectured, for Wall Street to show some discipline.
They have to start acting in a more responsible fashion if we are to together get this economy rolling again. There will be time for them to make profits, and there will be time for them to get bonuses. Now's not that time.
The president said he plans to talk directly to Wall Street executives, just as Treasury Secretary Timothy Geithner did earlier this week when he stopped Citigroup from taking delivery of a $50 million private jet after the bank got $45 billion in a taxpayer bailout.
We shouldn't have to do that because they should know better.
This is the point I've been trying to make all along. Jerome Powell has said that all he wants to do is lighten regulations on the banks.
You see, the bank collapsed in less than 36 hours. What is going on? Banks, they've always been symbols of stability, trust, and wealth. But truthfully, the banking system behaves as if it's one big legal giant scam. And I'm not so sure about the system as a whole any longer. Therefore, I can no longer turn a blind eye to what's going on with the banking system. And it's time we uncover the truth.
John, and this week is not starting out on a better note, despite the fact that depositors of both Silicon Valley Bank and Signature Bank are going to be made whole. And the Fed has announced this new bank term lending facility that is going to lend to banks at extremely favorable rates. That is not helping the regional banks this morning. Clearly, there is still fear out there about this spreading elsewhere. Just take
from the recent collapse of SVB to Signature Bank, and the latest, First Republic. This all sounds and looks too familiar to Lehman Brothers and Washington Mutual in 2008 during a financial meltdown, and 25 other banks, to the banks during the Great Depression. These key events in monetary history have shaped our modern day banking systems. But what can you do when the very thing that is used as currency is predicated and built only on trust and belief? What you believe to be truth and stability is in question, as 3 of the biggest bank collapses in American history recently happened back to back like a domino effect. Ladies and gentlemen, what we are witnessing may very well be the biggest Ponzi scheme we've ever seen.
If you work on a trading desk, stop what you're doing for 1 second.
Bernard Madoff became a household name.
The FBI arrested him this morning after he told senior employees yesterday that his business was a giant Ponzi scheme.
Tonight, as much as $50 billion is gone, vanished.
Mastermind of America's biggest financial fraud ever has died at the age of 82. When his giant Ponzi scheme was unraveled in 2008, the money manager's clients thought they had an estimated $65 billion in their accounts, but the money and the profits he said was behind it weren't real.
Madoff confessed he hadn't made a single trade in years. Critics like investigator Harry Markopolis earned the ultimate "I told you so."
I gift wrapped and delivered the largest Ponzi scheme in history to them, and somehow they couldn't be bothered to conduct a thorough and proper investigation.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here.
The thing that really jumped out at me was James Bullard said just last week, I think, he's the former president of the St. Louis Fed, that the Federal Reserve missed the banking crisis.
This is truly a great day for America.
They didn't see what was going on with the regional banks. And so you think about this. These are bankers, and they missed the consequences of their actions on the banks.
The legislation I'm signing today rolls back the crippling Dodd Frank regulations.
And so my sense that they're confused is not really even an opinion, it's a fact. And so the fact that Powell and the Fed kept raising rates, even just this last 25 basis point hike, really tells you that they're so fixated on inflation that they don't understand the lagging data that they rely on, and what they actually should be doing is dealing with the regional banks, because when they stop, that is a negative feedback loop that's going to really take everything down.
Legislation I'm signing today rolls back the crippling Dodd Frank regulations that are crushing community banks and credit unions nationwide.
In 2008, unemployment rose at 10% and millions lost their homes to foreclosure. What happened was mortgage-backed securities went awry because the financial system was not regulated closely, and it was like the Wild Wild West on Wall Street due to greed, corruption, recklessness, and monopoly.
The recession we're emerging from was primarily caused by a lack of responsibility and accountability from Wall Street.
What gives the US dollar or any currency value? The dollar has no intrinsic value. It's literally a piece of paper or a number on the screen. What gives it value is trust of the people in the government that decrees its value. So you can purchase goods and services. The government decreed therefore gives the US dollar or any other currency power. But still, fundamentally speaking, it's fancy paper that's built on trust. But what happens when trust is lost in a system that no longer serves the people? It serves its own self. The symbiotic relationship between Wall Street and Washington has always been weirdly paired. Nothing further proves that more so than the 2008 housing bubble that caused the recession the U.S. had not seen since the Great Depression of the 1930s. The most crazy part of this all is just the tip of the iceberg, my friend.
It's part of the reason our economy nearly collapsed. It's what led to countless home foreclosures.
As humans have evolved over time, so have our ways. Let's take the evolution of money. For instance, money as we know it, it's found its medium of exchange for goods and services, but that was only after going through stages of barter and commodity transactions. The use of money led to another entity you may be familiar with called the bank. Simply put, banks operate on a physiological phenomenon you may also refer to as trust. So the word bank and trust goes hand in hand together. You can't have one without the other. Along with trust, banks also provide interest on your money that you deposit. Surprise! This interest payment follows a basic concept of time value of money. So if a bank doesn't make any profits in the year or has a negative return on its investment, how exactly did the bank manage to pay you interest on your money? You see, that's where things get kind of muddy.
Be strong for the plant. She needs you.
First of all, let me state the simple fact that when you deposit money in a bank, the bank does not put the money into a safe deposit vault. It invests your money in many different forms of credit, in bonds, in commercial paper, in mortgages, and in many other kinds of loans. In other words, the bank puts your money to work to keep the wheels of industry and of agriculture turning round. A comparatively small part of the money that you put into the bank is kept in currency.
Those rules just don't work, but they shouldn't be regulated the same way as the large, complex financial institutions.
A person depositing money in a bank and trusts the bank with managing the deposit, and he or she could demand back their money whenever needed. But this transaction is perfectly fine as long as all the customers of the bank don't do the same thing at the same time.
An amount which in normal times is wholly sufficient to cover the cash needs of the average citizen. In other words, the total amount of all the currency in the country is only a comparatively small proportion of the total deposits in all the banks of the country. What then happened during the last few days of February and the first few days of March? Because of undermined confidence on the part of the public, there was a general rush by a large portion of our population to turn bank deposits into currency or gold. A rush so great that the soundest banks couldn't get enough currency to meet the demand. The reason for this was that on the spur of the moment, it was of course impossible to sell perfectly sound assets of a bank and convert them into cash except at panic prices far below their real value.
Banks are interconnected or interlinked and lend out money to each other. So one bank's loan money is another bank's deposit. And to avoid a systematic failure, banks are not allowed to lend all their deposits out. This mandatory threshold is called banking reserve. And the biggest difference between a Ponzi scheme and a bank, one has legal backing and the other doesn't. But let's be fair. Banks invest in things that have growth potential, whereas a Ponzi scheme is just money moved around. So you could easily characterize some similarities between the two, while also the dissimilar behaviors in banks and Ponzi schemes.
And that's what happened.
This hour with the U.S. COVID crisis, 148,000 new cases reported yesterday.
On March 26, 2020, the coronavirus pandemic had reached a boiling point. The Federal Reserve decided to reduce reserve requirements for all depository institutions to zero. So now banks are paid a specific interest rate on their reserve balance to encourage holding reserves. So in layman's terms, the Federal Reserve rewards banks that hold money. And this creates two situations. Banks playing a dangerous game of lending out most of their deposits or holding, not lending money.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run. I was just talking to old man Potter, and he's guaranteed cash payments to the bank. The bank's going to reopen next week.
But, George, I got my money here.
Banks seen an influx of money pushed through to them via stimulus, so you've seen record numbers of deposits. So, What happens when a bank plays this dangerous game? And there is no regulation. Banks with a low fractional reserve are susceptible to bank runs.
Will there be a global banking crisis? The collapse of 2 US banks is provoking fears about contagion. We have something called the CNN Business Fear and Greed Index summing up the mood right now. It is extreme fear, but it is fear and greed that ultimately really runs the markets.
Of course, they were the second and third largest bank failures in US history.
Charles Ponzi in the 1920s devised a scheme to make money using the very principles of trust and time value of money. Similar to a bank, Charles Ponzi collected bank deposits from people and guaranteed interest on the money he collected. But to gain trust, he paid astronomical interest to his early investors using new investors' money. Similar to a bank, when trust was shook, people demanded their money back, and that's when things came to a halt.
I found it. Only I found more than I had anticipated.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others.
This is where Silicon Valley Bank, or SVB, comes into play. Remember the part I said about record influx, fractional reserves? On Friday, March 10th, 2023, federal regulators closed SVB after word spread around town that something was brewing at SVB. The United States banking system would take a massive hit to its foundation built entirely on trust. This system built on trust would come under attack due to its important bank collapsing. This bank was important because it's home to many tech startups.
There were already requirements and public disclosures here, and there were flashing red lights. In December, SVB reported to the SEC it had no interest rate hedges on its bond portfolio. In March, the San Francisco Fed, this is publicly available, noted the banks in that district had the largest pace of decline in withdrawals in the country, perhaps due to higher exposure to accounts above $250,000. So this was already out there in the public space. Why didn't the chief regulator in Silicon Valley area, the San Francisco Federal Reserve, act here?
Your banks were on the verge of failure. You and other executives dumped millions of dollars in company stock in the days
this bank was on the verge of collapsing unless something was done. The government had created laws to protect and ensure everyone played by
the same rules.
Jerome Powell has said that all he wants to do is lighten regulations on the banks. Lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason. I said he was a dangerous man to have in this position. I said he was a dangerous man to have in this position. What he has done all along is lightened regulations on the banks.
Banks were on the verge of failure. You and other executives tried to cash out.
These laws under the Dodd Frank Act were put into place to stop another global financial meltdown from happening again like in 2008. But due to certain regulations and moves that were made, we are yet again seeing early signs of something deeper than what we initially believed. Mostly the bigger banks were regulated, but during the Trump administration, some regulations were rolled back under the Dodd Frank Act.
This is truly a great day for America and a great day for American workers and small businesses.
In the days after these bank collapses, people online, including Senator Elizabeth Warren, claimed former President Donald Trump rolled back regulations for the banks, with even the current president, Joe Biden, claiming the same.
During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.
And credit unions nationwide, they were in such trouble. But they shouldn't be regulated the same way as the large, complex financial institutions, and that's what happened, and they were being put out of business one by one, and they weren't lending. Since its passage in 2010, Dodd Frank has dealt a huge blow to community banking. 20% of small banks have been put out of business. They're disappeared. While banks that were considered too big to fail, we've heard that many times, too big to fail, had the resources to comply with Dodd-Frank's brutal maze of costly regulations.
This poses a few questions. Were banks rolled back during the Trump administration? Well, yes, they were rolled back, but it's difficult to say whether the stricter requirements would have prevented the collapse of SVB or Signature Bank. In 2010, former President Barack Obama and Congress passed the Dodd Frank Act aimed at preventing excessive risk-taking that led to the 2008 financial crisis. So the Dodd Frank Act imposed certain requirements on banks and systematically important financial institutions in excess of at least $50 billion, like the big banks. So as it turns out, what took SVB down wasn't entirely just mismanagement, deregulation. It was more than just that, with the biggest factor being the lack of faith, trust, and a system that is built entirely on trust.
We need accountability for our regulators who clearly fell down on the job, and that starts with Jerome Powell. And we need accountability for the executives of these large financial institutions. Look, there should be clawbacks for Gary Becker and the others who explode these banks. So you take back the bonuses and big salaries. And we should also bar them. And we should also bar them from ever being in banking again.
Obvious your banks were on the verge of failure. You and other executives tried to cash out. SVB executives, including Mr. Becker in front of us today, dumped millions of dollars in company stock in the days leading up to the crash.
I know there's been lots of discussions about compensation being short-term.
Mr. Becker, you made a really stupid bet that went bad, didn't you?
Senator,
and the taxpayers of America had to pick up the tab for your stupidity, didn't they?
Senator, there were a series of events, unprecedented events that occurred that led us to where we are today.
No, this wasn't unprecedented. This was bone deep, down to the marrow, stupid.
So from 2019 to 2023, while the FDIC identified an additional 45 liquidity risk issues, you racked up more than $20 million in pay. So, Mr. Shea, the collapse of your bank cost the FDIC fund $2.5 billion. So how much of the $20 million that you earned from loading up Signature Bank with risk are you planning to return to the FDIC?
I believe that Signature Bank was a responsibly managed bank, solvent until the end.
Yeah, well, I'm sorry. Your opinion on what is a responsibly managed bank is now laughable. So you're planning to return how much?
The answer is
none. That's it?
I'm not planning to do so, no.
I started out saying it's all one big, giant scam. And you know what? I can't entirely say the banking system is all one big scam any longer, because the infrastructure itself is built for stability and it works when it's right. When we go to a bank, we expect that the money we deposit in banks will be there when we need it the most. Now, what I will say, the system is deeply flawed, because the moment we deposit money into the banks, it's quickly loaned out. And as of now, the reserve requirements are zero, which promotes banks to live on the edge. Therefore, a system built on trust isn't exactly trustworthy if our money isn't sitting in the vault. Maybe President Andy Jackson knew something we didn't know when he said the banks were too powerful. Maybe he wanted to stop them before they became
too big to fail.